everyone. So normally I do a wee run-in of people's bios before we get to the point that I'm actually getting them to introduce. But I think, given we've got a panel session, we'll go and introduce. I'll give you a chance to do your own bio. Although I did notice, Derek, you've got 41 years of finance experience, which is pretty impressive. So I think also, just when we go through the introductions, it'd be interesting because we've clearly got two people from the same organisation here, Derek and Nick, both from White Oak. So just in terms of why your roles are different, but both have a touch on it in insolvency and restructuring. So Derek, can I get you to tell us a bit about you first?
Yeah, no problem at all. Yes, 41 years. First job was with one of the high street banks back in 1982. And I classed my career starting actually from 1987 when I get my first job in asset finance. And I've been doing that ever since. Currently, I'm the head of sales at one of the sales channels within White Oak. And in the Glasgow office here, been doing that since 2019, been open in Glasgow since 2019. Difference, I suppose, between Nick and I is I deal with a stressed business, where Nick would deal more with the distressed business, and there is a subtle difference between how White Oak would react to each of those depending on where you are in that graph.
Okay, well, we'll touch on that in a moment. But Nick, what's your name and where do you come from?
Okay, hi there, thanks. Yeah, my name is Nick Isaacs. I'm the Chief Risk Officer at White Oak. We're a UK-based small and medium-sized business lender, so providing capital to businesses. Just a bit about me. I've worked right across the credit life cycle, from sort of underwriting through account management and also into the back-end collection space. And as Derek mentioned, that's my focus specifically at White Oak, and also with relevance to this debate. My technical background is in credit risk, so I had 15 years globally working for American Express. And at White Oak, as mentioned, I'm responsible for the collections team. So we have an internal team of collectors who are working with our customers. We also have an in-house litigation specialist who then works with solicitors and insolvency practitioners and restructuring experts. So yeah, those are the folk. Those teams report into me. So that's what I'm doing at White Oak.
Okay, thank you, Nick. And Jamie.
Lawyer and have been for 15 years. When I started, the work was almost exclusively, kind of lender or bank-led work. And that has shifted significantly over recent years. Probably down to maybe 30%. And I've also spent some time on secondment to the business support teams of two different high street banks over that time. So I can give some insight into how those banks have deal with the stress and how that has developed.
Okay, thank you, Jamie, and thank you to everyone for agreeing to take part in this discussion. So, Derek, just in your introduction there, you spoke about stress rather than distress. You're customer facing. So, what are the signs of stress? How do you see them, and what are they?
Early stage stress is where the business is starting to find tight cash flow. It's starting to struggle to meet its on terms payments. It's maybe it's receiving some unexpected news, unexpected bills, unexpected costs. Those situations develop stress in a business, and we as a business are providing solutions to that stress if it's caught early enough. We can get forbearance requests, we can get specific requests that we have to assess as whether they are stress related or distress related.
Okay, and when you speak about forbearance, what does forbearance mean? For those that don't know,
payment holidays was the very obvious one during pandemic. When pandemic hit, the industry was inundated by holiday requests, literally can I not make any payments to you for an agreed period? And we had to handle those inquiries as sympathetically as we possibly could, but also understand that we had shareholder demands and everything else that goes with that.
Okay, thanks. So that's the stress. What about when we move into stress? So Nick, that's more your bag.
Yeah, I think so. And so I think there's probably, Derek mentioned early stage triggers. So I think this is things that a lender would see with their internal data. So it could be things like a deterioration of financial metrics of an existing customer, depends how close the relationship is, what information is received. There may be, depends on the sophistication of the lender. So there may be account management scores or triggers if there's, a rule-based system running, or it could be an underwriting event. So there could be a new deal coming, which means there's an evaluation of the customer's position. And when looking at the financial metrics, you may see, some of those indicators. There's also then some, I guess, generally more severe later stage triggers. That would be a payment default. So again, if you have, with our business, we have contractual payments monthly on loans. And if that payment is missed, that's an obvious indicator. Or there may be an event that is reported externally. So the credit bureau might hold a default, might report a default event at another lender with your customer. Or perhaps even further down the track, some kind of legal notification. So there might be winding up proceedings, a notice of liquidation. So those are the kind of, those are some of the late stage triggers. And then there may be one other piece that might be considered that might be more macro factors. So it could be, as a lender, you might be concerned about a specific segment or industry. And if I think back to, COVID, there was times when certain businesses had to close. So that would be, right across the segment that you may want to consider.
Yeah, I think there's another example of that would have been the oil and gas sort of then when the price hit. So then I think a lender would be looking at any business that either had that SIC code or perhaps operated in the northeast. Okay, so when we're speaking then about when so it's the distress and you're identifying the stress in your portfolio, what is the White Oak approach to dealing with that distress, the distressed clients?
Yeah, we have, we aim to have long-standing relationships with our customers. So we generally know our customers fairly well, have good relationships there. So when we initially, we're trying to, I guess, classify that situation. So if I take the example of that payment being missed, there'd be what I'd call an early arrears situation, which would be perhaps the first, day 1 to day 10 or 15 following missed payment. So we've got a dedicated team there that reach out to our customers. So we're outbound calling. We're looking to contact the customer because we're really trying to get information and understand if it is, stress or distress. So there, with the outbound call, obviously, number one is we need to connect with the customer, and then just try and find out what's going on to try and determine, is this some kind of a blip and not a major issue, or is there some sort of event that's more serious that may require a different solution? So again, it's just about the quality of the information, and then we can determine if there's sort of some short-term or long-term help needed. Short-term, Derek has already mentioned, it might be things like a payment holiday or some kind of arrangement. And then if it's longer term, again, it depends on the specific situation and the sort of profile of the customer in terms of what could be offered there.
Okay, so Jamie, if I could just bring you in here, because that's the White Oak approach. Now, you mentioned that you've spent time working in Scotland, 2 different lenders with their special support units, but you also obviously that's all the security review work that you were speaking about in the old days when it was a lot of bank-led work that you did. You'll have a bit of an awareness about different ways, the different models of approach that lenders might have to helping and supporting the distressed clients?
Yeah, sure. I think if you look back to the financial crash in 2008, certainly in Scotland, a lot of the distress was in the real estate sector. So, due to properties being revalued, and so some banks, for example, had dedicated real estate teams to deal with distressed real estate, and that would include, I suppose, real estate professionals being part of that team and helping finding solutions. A lot of that has now gone, certainly in Scotland. There are still perhaps banks in London will have dedicated teams to specific sectors, but that has certainly gone from Scotland now. In terms of different ways of, I've seen kind of banks using different models for managing the customer relationship with distressed businesses. One model which banks use is to, once a case is deemed to be in a distressed situation, the case will actually transfer to a new team. So, a new relationship manager will take control of the case and will be introduced to the customer. And I suppose that's seen as having a fresh look at the case by somebody who is more used to dealing with businesses facing distress. And I think there can be a bit of a feeling that the people who've maybe seen the customer through the bank from the start might be constrained in some way by historical relationships. So it's good to get a fresh look. Whereas another model is a shadowing relationship, whereby the relationship manager who has the case will continue with it, but will be shadowed by somebody who is in the business support team. And there are pluses and minuses for different approaches, and some can be seen as a positive by the customer, and whereas others can make the relationship more difficult. So it just depends, and banks can try these different models on different situations. I know, and of course, the smaller lenders are more likely to maybe just have a small number of people in the team, in the support team, so they wouldn't have the ability to transfer cases wholesale. Other models that I've seen, one bank has a team that purely deals with enforcement. So if you've got a case that's approaching enforcement, it will transfer to that team. They will manage that process, deal with the professional advisors that are involved, and then perhaps once it's gone through that, it will transfer to another team. And I think one final point to make in relation to business support teams and different approaches is that some banks will have effectively the business support team acting as the credit function, as well as the sort of frontline function. So credit's sometimes seen by people who are not within banks as this sort of mythical beast that you never meet, and you have the frontline person negotiating terms, but they're always subject to credit, and you don't know what credit are going to say, or whether they're going to add more conditions, and that can make it, I suppose, add some confusion sometimes, or another layer to deal with. Whereas, as I say, some business support teams will act as the credit function themselves, so they can agree things in meetings with customers that's the final say, that's them agreed, and then they just need to be put in place. So I think for advisors, it's helpful to understand what they're dealing with, and the different factors that will influence how a lender is going to deal with things, take next steps. If you're subject to a credit team and you don't know what they're going to say, then that's another layer that everybody's having to deal with. So, and I think as well, just maybe leading on to asking Nick a question, it's helpful to know for advisors, again, who's making the instructions of advisors. Is it the person that's the relationship manager, or is it the credit team, or is it a specific business support person that will make that instruction? And so I'm interested to hear about White Oak's approach in terms of instructing advisors, who does it, when do you do it, are there particular parameters that mean, once you've hit that, you'll instruct a security review, or you'll instruct an IBR, or whatever that might be.
Okay, I think if I take that one, I think it depends where it is in the life cycle. So Derek's already mentioned there's some, stress cases where the person who's managing the relationship would look after it. And then Jamie, you've mentioned that there's different teams it can flow to. So again, it's the same for our organization. It depends who is, I guess, the primary contact person for the customer at that point. With the teams that I'm managing, that's going to be a collections specialist. So they're the people who will then be interfacing with any third party. So those third parties may well have been appointed by the business, or at times, if Derek has a customer that's in a stress situation, then we might recommend that they speak to a advisory firm or a restructuring specialist if that's what they need at that point. I think what's interesting with them, when you bring that third party in to support that firm's management, what we would understand as a lender is that often we're not going to be the only creditor in that situation. So that so there's a need for some, I guess, alignment around these things, and that's where these situations can become quite challenging, because they can become quite disparate. Different banks and non-bank lenders will have different policies in terms of who they deal with and how they deal with them. So that can complicate things. And then it will come down again, if there's a level of if a company is moving into administration, then it can come down to voting rights in terms of the actions that are taken.
Okay, I think we touched on, we mentioned a couple of things there just in terms of security and IBRs. Are those the sort of things that you would instruct Nick, or sorry, I guess it's, so I get, who is it that's instructing? Is it White Oak, or is it White Oak suggesting to the customer that they should be getting advice and they should be getting this done?
Well, it depends on the situation. So, I think there's, I don't know, perhaps there's a couple of different types. There's some customers where the management of the firm will have already engaged with advisors because they perhaps are more forward-looking and they recognise they need some support or some professional help. And then there's another profile. It's hard to make generalizations. It could be a smaller business that doesn't have quite the same structure. Could be more of an owner-operator where they're perhaps in the business and engaged in running the business or trying to save their business. And that's where we might suggest they need some help because it may not be their specialized area. And to save their business, they might benefit from having a specialist at that to help them. Yeah.
Okay, thanks. So going back to security reviews, Jamie, can you just sort of set out what a security review is and why banks like to get them?
Yeah, sure. I suppose they can have several functions. I suppose the main or sort of primary function that most people would think of is to check whether security is valid and enforceable. And that could be for enforcement purposes if you're thinking you might be going down that road, but also just whether your security can be relied upon for general negotiation with the customer, perhaps other lenders, and also for your distribution. If there is an enforcement and there's recovery to distribute, just to make sure that you understand how those should be distributed relative to security. They can be used for understanding your enforcement options. Like I said, if that's the route you're going down. Other functions to identify any gaps. So, have you got any gaps in security? Are there any, assets not secured, for example, or, is there any cash leakage somewhere? Maybe going to a group company that's not part of the security net. And are there any options at that point to improve the security, to improve your position? Can you take anything to improve things for you. I suppose your rights relative to other lenders, just how you sit in terms of ranking, for example, and I suppose just generally knowing the full picture, to help with discussions and what steps you may take going forward.
Okay, thanks. So you've got the stress, and you've got to Nick, I'm speaking to. You've given some advice. There are some options that come out of that. What are the sort of solutions, I guess, or outcomes that you see when you've got a stressed client?
Well, I think for any lender, there's probably a decision point, which is whether they're whether they believe the customer is viable and their situation is viable. And if it is, then obviously you're looking to support as much as possible. And then there's the other situation where it doesn't look viable, and in that instance, you're looking to minimize your losses or sort of maximize your return out of the situation. So, and that can also be in some of those scenarios. Again, as a lender, you'd assess a case, and there may be times where we've sort of, Jamie's touched on security. I think this is where this comes in. There may be times where you believe the customer, can pay but doesn't want to pay, and that's, but if you believe the means are there, that's generally when you're going to be in a litigation type situation.
Yeah, and I guess enforcement then. White Oak do enforce?
Yes, we do. We have a litigation manager who works with two main solicitor partners. We do work with a couple others, but a couple of main ones, and they enforce on our behalf. Our head of collections also would be involved on larger value legal cases. So yes, that's generally winding up on companies and bankrupting of individuals is the action there.
Yeah. Okay. So go back to you, Derek, because I guess you're here partly because of that the early signs of stress, but also sometimes an answer is it could be lend more money, new money to an existing client, new money to another client that's a new customer that's distressed. So what are the considerations when you're looking at lending to where there is distress?
I think that between stress and distress are much the same. I think it's about viability, and it's the solution or the action that becomes slightly different. So, and I think the thing that you always tell people is that to speak to their lender as quickly as they possibly can, because the actions can be different depending on the timeline and the levels of stress versus distress that's there. But the assessment is the traditional ways. It's looking at past trading, both their normal trading function and their payment history, been good payers for a long time. And most importantly, what is the cause of the stress? Is it a single instance of issue? Has a company went down on them in bad debt situation that they can overcome, but it's causing them a minor blip? Is it a more ongoing thing that's causing the issue? Could it be poor credit control, slow payments from from clients, etc.? Poor payment terms to suppliers. It could be things like that simply need some adjustment, and/or a different financial product being used. So from a customer facing aspect, we're looking at that client and saying, is the solution an wallet or a different finance mechanism to provide that new money? And/or is it a situation where it's actually better dealt with from Nick's team and it's crossed the line over into distress? But we'll look at things like products. Is a product suitable for them, whether it's products that we offer or products that the market can offer? We have external funded partners that we can look at who have got different credit appetites and different products to us that we can introduce them to. And again, if we, from a customer facing perspective, see the solution as being new money, then we will consider all the options and present all the options that are available to the client. And if it's not new money, we have to make the call that that's a more distressed requires Nick and his team to get involved. And that's why you can get two different reactions depending on the timeline with the same organisation, depending on the timeline and the approach and the severity of that stress versus distress situation.
Okay. Nick, is there anything you'd like to? You were nodding there.
Yeah, I think I just agreeing with Derek's point, it really is about the communication, and I kind of touched on that can be challenging when there's when you're trying to build consensus with multiple lenders, and they'll have different decision making, different speed of decision, but yeah, it's really important that communication is there and that there's a level of consensus and clarity in these situations.
Okay, Jamie, just when we're speaking there about getting different lenders to reach agreement, what's your experience of that?
Yeah, it's well, I think one thing to be, I suppose, along the security review point is to start from a place where you understand the different agreements that are already in place. So I'm thinking along the lines of intercreditor type arrangements, and to know exactly what they say, but particularly if you're a junior creditor or a not the first ranking creditor, because often the intercreditor arrangements will be very senior creditor friendly, and they will have quite a lot of restrictions on what junior creditors can do. So it's just to make sure that you understand what they say and you don't fall foul of that. They also might regulate the passing of information between creditors as well. So again, before you have any conversations with them, just make sure you're understanding what they say. And yeah, I suppose one other point to be aware of are restrictions on enforcement. So again, if you're starting to go down that route and there are other creditors involved, you might find that you're prevented from starting an enforcement process without consent, for example, or without waiting a period of time. So I suppose go in with your eyes open and make sure that you understand the intercreditor arrangements before acting.
Okay, thanks. One thing that I know with I guess I'm going to speak about pre-pack administration type thing, where you have a company that goes into an insolvency process, and it is the business and assets are purchased by existing management or shareholders. Nick, what's your view on that?
Well, managers could be one thing, right? If they're not owners. Same ownership is perhaps a different scenario. So it probably depends. I think with any lender, there's always caution lending to any new start organisation. There's not a track record of trading. But really, it would be understanding what happened to the prior entities. So were the creditors unsecured? Perhaps you're left high and dry in that scenario. Did the owners lose any money? Did they have any skin in the game, in essence? Did they put money in to try and help save the business? Those are some of the things that I'd be interested in, because what I'd be trying to build a picture of is sort of the character of that borrower, of that Phoenix company, which would then feed into any underwriting assessment. So there's a judgment call that would be made. I think probably there's some organisations that would just have a straight policy that would say we don't lend to Phoenixes, but I think certainly from a wider perspective, we'd consider it in exceptional circumstances, but we'd want to fully understand the backstory behind it.
Okay, so I'd just like to say we've got about 10 minutes in this session left, so we've still got time make some time for questions if there's anybody out there that would like to ask some specific questions, but we'll continue to move the discussion on. And we had an economic update today, so I don't know if any of you managed to get signed into that, but it was sort of, although pretty pessimistic picture, there are lots of reasons to perhaps be cheerful. We also, and I think that nobody's forecasting the massive rise in insolvency numbers that we'll all have our own opinions on that. So, Jamie, what's you got a view? What do you think is coming up in the economy?
Well, I took from the economic the update that it was slow growth, but generally the outlook was positive, kind of muted positiveness, but people thinking or the view is that things are going to improve for the economy generally. It still feels like insolvencies have not caught up with that. He showed the chart of the different insolvencies and the progress over since the pandemic, and the numbers sort of returning to normal levels, but a different mix. So a lot of that is creditor voluntary, CVL insolvencies increasing significantly, but more administration type insolvencies still remaining low. So it feels like there is still a bit of a catch up, but it's difficult. I'm reluctant to make any predictions just because I think our profession probably as a whole has got it wrong over the last couple of years. I think everybody would have predicted more of an increase than there has been at different stages over the last few years, and it just hasn't materialized. So perhaps due to the resilience of businesses, and maybe that will continue. I think certain sectors, well, there's lots of sectors that are impacted still by everything that has gone on. But I think in particular, maybe there are sectors in Scotland, particularly sectors funded by public sector, where I think there's definitely more issues to be worked through. So yeah, that's kind of difficult to predict, I would say, but that's as far as I want to go. I don't know if you've got other views, Nick and Derek.
I'll come in, Nick, if you want. I think Jamie's right. I think everybody was braced for the worst. I think recovery teams were being boosted all over the banking sector, and we were expecting things to be much more difficult than they seem to have turned out. However, I've got to say that, as I alluded to at the start of this, I've been around for a little time, and I've gone through some recessions, and this feels like going through a recession. We are seeing bad debt increasing, we're seeing collections, we're seeing credit policy tightening. What we are still seeing, however, that sort of contradicts that recessionary time and feel, is that we're seeing full employment. We're seeing a lot of activity and a lot of opportunity in the business community, and we've been requested to support some of that opportunity. And that means that the statistics say that we're not officially in the recession that it feels like we're in. Moving forward, who knows where that's going to go? Is that going to go slipping into that technical recession and the feelings that we've got being expressed more statistically? Or are we going to see an upward trend? I think we've got a general election coming, for example, that changes the behaviour of that public spending purse. Governments tend behaving differently pre-election than post-election, and they may want to buy themselves some votes by spending on some infrastructure and keeping those jobs numbers up and keeping the statistics on a positive. We just simply don't know how that's going to be and what restrictions there's going to be. I think there's certain industries that have struggled more during and after pandemic that the panel have alluded to, and I think they will continue to find their recovery a little bit more difficult than others. So let me put a coupon on for the football on a Saturday, but I ain't going to bet on whether we're going to see a positive economy going forward. It's a difficult one.
Thanks, Derek. Nick.
It's definitely tough right now, I would say, based on what I see in those insolvency numbers. I think what's relevant is if we think about the environment we've come from, we've come from an environment of low interest rates and substantial government support, so that clearly aided a number of businesses. And Jamie's mentioned the catch up. And I guess the question is, have we caught up, or is there some more catching up to do? There is more HMRC action. There were also court delays. These things aren't insignificant either in terms of working through a backlog. But it is a tough environment. High interest rates, high inflation. Before there was that. There was a level of government support, and now I think businesses are left with sort of heavy debt burdens, also a tight labour market. So it's pretty tough. But as Derek says, there's an election coming, and I don't think anyone's brave enough to predict where it's going. I think the only positive I see at the moment is inflation year on year does seem to be easing a little bit. So that's as good as it gets, I think, at the moment.
Okay, thanks. So I think probably time to bring our session to a close. Has anybody got any final remarks or comments before we finish up?
I think to just confirm what Nick mentioned there with HMRC, I think again HMRC have behaved during pandemic and post-pandemic in a very friendly way. They traditionally are not our friend. They are collectors of our tax, and we demand them to be collectors of our tax. And their behaviour is starting to turn towards being more the tax collector than the friend. And if that continues to firm up, that's going to affect how businesses are able to get through what is this low growth economy that we're in at the moment.
Yeah, and I think just to add on that, there needs to be something that for things to happen, and I think lenders, if that's fair, are less likely than they were pre-pandemic to maybe push customers down a road of taking steps when they're in distress, whereas HMRC, they are there to do that, and so yeah, I think more activity from HMRC will increase activity in our area.
Okay. Well, thank you very much to Derek, Nick, and Jamie for taking part in the discussion on the interaction between insolvency and finance and the banks.